This isn't a recession, it's a financial recasting of the entire world order, and it's happening in plain sight. For the past 2 decades, a quiet but undeniable bargain fueled global growth. Emerging nations borrowed trillions of dollars at historically low interest rates, betting on a future where their economies would outgrow their debts. But that bargain has just been shattered. The system has turned against them. The mechanism is deceptively simple. The U.S. Federal Reserve, in its battle against domestic inflation, has embarked on the most aggressive interest rate hike cycle in 4 decades. And when U.S. rates rise, the entire world's financial plumbing seizes. This isn't about one nation's policy, it's about the psychological bedrock of modern finance. The US dollar is the world's ultimate safe haven. In times of stress, capital stampedes back to where it feels safest, leaving emerging economies exposed. The numbers are staggering. Over the last 2 years, emerging market and developing economies have faced their largest capital outflows since records began. For every dollar that flowed in, nearly 3 have fled. This isn't normal market adjustment, it's a systemic withdrawal. The consequence? Currencies in these nations are plunging. A weaker local currency makes repaying dollar-denominated debt exponentially more expensive. Imagine taking out a mortgage for $100,000 when your local currency trades at 50 to the dollar. That's 5 million local units. If your currency collapses to 100 to the dollar, your mortgage just doubled overnight. The debt hasn't changed, but the burden has become unbearable. This currency debt doom loop is now active in over 50 countries. Why should you, an individual thousands of miles away, feel this? Because this instability is the primary driver of everything from your grocery bill to your investment portfolio. When a nation faces a currency crisis, it stops importing grain to preserve dollars, tightening global food supply. When a country defaults, it rattles the bonds held by your pension fund. This is behavioral economics on a planetary scale. The herd mentality of institutional investors creates tidal waves that eventually wash up on every shore. Your cost of living is intimately tied to the solvency of a nation you may never visit. We are witnessing the first waves of a sovereign debt crisis of unprecedented scale. But the terrifying part isn't the defaults themselves, it's what they will force these nations to do next. And the options on the table reveal a geopolitical game far more dangerous than the financial one. The trap was set long before the rates began to rise. The real story is in the fine print. To understand the coming crush, you must see debt not as money owed, but as a system of control. During the era of cheap money, emerging nations rushed to global bond markets, issuing dollar-denominated sovereign bonds to pension funds and asset managers in New York, London, and Zurich. This was seductive. Less conditionality, faster money. But it transferred risk from multilateral organizations, designed to manage crises, to private markets, designed to flee from them. The psychology here is critical. A bond fund manager has a fiduciary duty to protect assets, not a nation. At the first sign of trouble, their algorithms trigger sell orders. There is no negotiation, only exit. Here's the mechanism nobody fully appreciated. The structure of this debt has fundamentally changed. A staggering portion is now held under foreign jurisdiction, meaning bond contracts are governed by English or New York law. If a country defaults, the legal battle won't be in its own courts. It will be in London, where vulture funds can swoop in, buy the defaulted bonds for pennies, and sue for full repayment, seizing the nation's overseas assets. This isn't a hypothetical. It happened to Argentina for over a decade. Now imagine this scenario playing out across multiple countries simultaneously. This creates a perverse incentive system. Faced with the specter of a predatory lawsuit, a government's rational choice is to impose brutal austerity on its own people, slashing fuel and food subsidies, cutting health budgets, to scrape together dollars for distant bondholders. This is the brutal math of behavioral systems. The pressure of an external, faceless market can force internal political decisions that ignite social unrest. The markets, in seeking security, engineered the very instability they feared. So the playbook is clear: raise rates, trigger outflows, force austerity, and demand repayment. But here's the part nobody expected. Faced with this financial ultimatum, a growing number of nations are not choosing austerity. They are choosing a different patron entirely. The old financial world is demanding payment. A new one is offering a way out, with strings attached that will reshape the 21st century. Historically, a debt crisis meant a pilgrimage to Washington, D.C. and the IMF. The terms were strict but standardized. Today, there is a Beijing alternative. As Western capital retreats, Chinese state-owned banks are stepping in with bilateral loans for specific infrastructure projects, ports, power plants, digital networks. The psychological framing is different. It's not presented as a humiliating bailout, but as a partnership for development. This is Power Structure Insight 101. He who provides liquidity in a crisis gains immense strategic leverage. The historical parallel is the 1970s oil crisis, which recycled petrodollars through Western banks into Latin America, leading to the lost decade. Today, we see a Belt and Road recycling of Chinese capital. But the connection goes deeper. These loans are often structured with commodity-backed repayment clauses. Oil, minerals, and agricultural output are used as collateral. This shifts the risk for China from a financial default to a simple seizure of physical assets. Furthermore, the infrastructure built often integrates with Chinese technical standards, creating long-term dependency. This isn't just debt diplomacy, it's systems capture. For other global powers, this creates an unbelievable turn. The desperate search for dollars is pushing nations into yuan-denominated loans, slowly eroding the dollar's monopoly. For the average citizen in a debtor nation, the immediate relief might be palpable. No IMF-mandated layoffs today. But the future trade-off is a profound loss of strategic autonomy. This is the behavioral economics of desperation. A high-cost, long-term solution becomes rational when the short-term alternative is immediate collapse. The world is thus splitting into two competing financial spheres. But it gets deeper. This geopolitical tug-of-war over debt is masking a more profound and irreversible shift happening within the economies that are about to be crushed. While financiers and geopoliticians maneuver, a generation is being locked out of its future, and their response will define the next 50 years. The media narrative focuses on sovereign defaults and great power rivalry. The unreported story is the human capital collapse. When a country spends over half of its government revenue on foreign debt service, it isn't just a line item. It is teachers not hired, vaccines not purchased, roads not maintained. A nation's most valuable asset, the health, education, and skills of its young population, is being starved to service obligations to foreign creditors. This creates a devastating paradox. The very demographic dividend that was supposed to propel these economies is being mortgaged before it can ever pay out. This leads to the shift almost no one is discussing. The brightest minds in these pressured societies are not waiting for rescue. Faced with stagnant opportunities, they are leveraging the one tool that remains globally accessible: digital technology. We are witnessing the rise of a bypass economy. African fintech startups are building parallel financial systems. Indian engineers are creating global software companies from second-tier cities. Latin American platforms are integrating directly with Asian manufacturers. They are building growth not through sovereign credit ratings, but through digital connections. This is a silent, grassroots rebellion against the failed financial architecture of their elders. For you, this means two things. First, the inflationary and market volatility triggered by the debt crisis will continue, as the systemic pressure is nowhere near resolved. Second, your next major competitor, collaborator, or disruptive innovation is increasingly likely to emerge from this pressure cooker. The entrepreneurial energy born of sheer necessity is formidable. The countries that navigate this debt storm will not do so through traditional austerity alone. They will do so because a tech-savvy generation bypassed the broken system and built new ones from the ground up. So, while the headlines will scream about debt negotiations and bailouts, watch the quiet spaces in between. Watch the coding boot camps in Lagos, the startup incubators in Jakarta, the digital marketplaces in Bogota. The old financial world is fracturing under the weight of its own design. But the new one isn't being built in the halls of central banks or finance ministries. It's being built by people who have stopped asking for permission and have nothing left to lose. And that is a shift more powerful and more permanent than any debt default. Because the real transformation isn't in who holds the debt. It's in the millions deciding to build a system that doesn't need it.